How's it going, everyone? I hope that you're all doing well. I want to welcome you to the execution protocol, where we're going to discuss entries. Now, this is the first step in the execution protocol. In future lectures, we will discuss invalidation levels as well as targets. Before you've executed a trade, it's important that you've defined your entry, your stop loss, and your targets. Without these three reference points in advance of executing the trade, there is no trade idea. And so it's very important that all three are defined. And so in this lecture, we will discuss entries. And so without further ado, let's get into today's lecture. Just to remind you, the execution protocol, we are now on the lower time frame perspective. Price has now reached our point of interest. We've identified SMT. We've identified a change in the state of delivery, and time now meets price. What we now need to do is define our entries. Now you might be wondering, okay, well, how do we exactly define our entries? Well, if you remember from the order flow lecture, the way we define order flow is by utilizing the left side of the curve within the context of a market maker buy model. The left side of the curve is the sell side of the curve, and the way we determine order flow on the right side of the curve is by utilizing PD arrays that formed on the left side of the curve. We extend them to the right, and we anticipate them being utilized as supports. Now, the arrays we are paying attention to were order blocks. So for example, we have 3 bearish order blocks here. Every time price is placed above a bearish order block that formed on the left side of the curve, on the right side of the curve, it must be utilized as support. This is now a bullish breaker. This next order block is a bullish mitigation block, and this is also a bullish mitigation block. And so what we're going to do is we're going to identify an array that formed on the left side of the curve, extend it to the right, and that is the array we're going to utilize as our entry points. And so, for example, if we have some bearish order blocks that formed on the left side of the curve, once it's placed above or on the right side of the curve, must be utilized as support, meaning we can utilize these arrays as discount arrays, and this is where our entries will form on the right side of the curve. We can also pay attention to imbalances. So for example, we could have a bearish value gap that formed on the left side of the curve. Notice that these imbalances have been utilized as resistance on price on the left side of the curve. Once it's placed above on the right side of the curve, should be utilized as supports. And so again, we're utilizing an array that formed on the left side of the curve. We extend it to the right, and once it's placed above, must be utilized as supports. That is how we're going to define our entry points. If, for example, we cannot refer to arrays that formed on the left side of the curve, maybe because the left side of the curve is extremely far away, then what we will do is refer to arrays that form on the right side of the curve. For example, imbalances that could form. We could have some bullish order blocks that form, price retrace into it, and expands higher. If we cannot refer to the left side of the curve, we utilize the right side of the curve. And again, the arrays we're going to be utilizing are imbalances as well as order blocks. What we can see here is a market maker buy model where we've got original consolidation, left side of the curve, smart money reversal, right side of the curve. What we can see is we've got this bearish value gap that formed on the left side of the curve within this market maker buy model. Once it's placed above, should be utilized as support. This here would become a potential entry point. What we can then see is that price is placed above this bearish order block that formed on the left side of the curve. Price is placed above it, retraces into it, utilize that support. Again, this would become a potential entry point. We have this bearish order block here that formed on the left side of the curve. Once it's placed above, must be utilized as support. This would become a potential entry point. And so what we can see here, by utilizing the logic of market maker models, we've got this imbalance here, this bearish order block here, and this bearish order block here, all forming on the left side of the curve. Once it's placed above on the right side of the curve, are utilized as support. And these arrays are where your entries are going to form. And so we're going to utilize the left side of the curve to measure order flow on the right side of the curve. What we can see here is another market maker buy model. We've got original consolidation, left side of the curve, smart money reversal, right side of the curve. What we can see, we've got this bearish order block formed on the left side of the curve within this market maker buy model. Once it's placed above, price retraces into it, utilize that support. This would become a potential entry point into the right side of the curve. We've then got this bearish order block here that formed on the left side of the curve. Once it's placed above on the right side of the curve, must be utilized as support. However, price delivers into the original consolidation after utilizing the initial bearish order block as support on price. If we look at another market maker SAR model, we've got original consolidation, left side of the curve, smart money reversal, right side of the curve. We have this large expansion leg higher, forming these inverse fair value gaps. Once price displaces below, that becomes a change in the state of delivery. What we then see is we have these bullish order blocks that formed on the left side of the curve. Once displaced below on the right side of the curve, must be utilized as resistance. And so once price retraces into them, these will become potential entry points. We then have this bullish order block here. Notice how many times it's been utilized as support on price. Very important price range. Price then displaces below it. Utilize as resistance once and twice. That'll be another 2 potential entry points. We then have this bullish order block here, which is utilized as support on price multiple times. Once displaced below, must be utilized as resistance. And so again, this would become a potential entry point. And so what I'm showcasing here is we already have the left side of the curve printed, because once we have a change in the state of delivery, that confirms to us that we have a market maker SAR model that is now unfolding. We can look to the left of the smart money reversal all the way to the original consolidation. This is your left side of the curve. And what we can do is identify discount arrays that formed on the left side of the curve, extend them to the right. Once displaced below, they must be utilized as resistance, and those are where our entries are going to form. So now what we're going to do is we're going to walk through some executions that I've taken, just showcasing to you how I'm utilizing the left side of the curve when I'm entering a trade. So if we look at this market maker buy model, we've got original consolidation, left side of the curve. I'm now waiting for CSD. You can see I've annotated these imbalances, these volume imbalances that formed on the left side of the curve. If price is placed above them, that will be CSD. However, price utilized it as resistance. I'm now on a 5-second time frame, and you can see I've annotated this bearish fair value gap here. Notice this forms on the left side of the curve within this market maker buy model. We've now displaced above it. And so once price retraces into it, that's where I enter the trades. And so I'm utilizing the left side of the curve to measure order flow on the right side of the curve. And my entries are going to form at those arrays that I anticipate to be utilized as support once extended to the right, delivering the right sides of the curve. If we look at the next market maker SAR model, we can see original consolidation, left side of the curve, smart money reversal, right side of the curve. Now waiting for CSD. You can see I've annotated this imbalance that formed on the left side of the curve. Price then retraces into it, expands away from it, retraces into it again, displaces below it. That's a change in the state of delivery. And so I enter short once price retraces back into that price range here. Notice that we've got an imbalance here that was utilized as support multiple times that formed on the left side of the curve. Within this market maker SAR model, once it's placed below on the right side of the curve, must be utilized as resistance. And so if I anticipate it to be utilized as resistance, that'll be where my entry will form. And we can see I entered shorts, and then price delivered the right side of the curve after utilizing that array as resistance. If we look at the next trade, what we can see, original consolidation, left side of the curve, smart money reversal, right side of the curve. You're going to see me annotate this imbalance now in a moment. That's where my entry is going to form. I anticipate it to be utilized as resistance. Annotated it. Price retraces back higher into this bearish order block that formed after utilizing this array as resistance. And so this now becomes my entry point. I'm basically blending the left side of the curve now with the right side of the curve. I see an array that forms. Once it's placed below, I see it actively being utilized as resistance. Bearish order block forms, this up close candle. Once price retraces into it, that's where I enter shorts. And then we can see the right side of the curve is delivered into the original consolidation. And so if you'll notice, I was trading a market maker SAR model within a larger market maker SAR model. Notice that I've only annotating arrays that formed on the left side of the curve. We've got these imbalances here, utilized as support on price. Once it's placed below, must be utilized as resistance. This imbalance here, support on price. Once it's placed below, must be utilized as resistance. And so again, I'm annotating arrays that formed on the left side of the curve, extending them to the right. And every time price retraces into it, that's an entry opportunity, assuming you have a valid stop loss and targets. If we now look at this market maker buy model, we've got original consolidation, left side of the curve, smart money reversal, right side of the curve. We've got this bearish order block that forms. Once it's placed above was a change in the state of delivery. And so what you're going to see me now is enter long at this bearish order block, which is now a bullish mitigation block. I'm going to play this video out. I want you to pay attention to what arrays I annotate. And so you can see I've annotated one discount array here, this order block here. You've seen me now annotate this imbalance here. Why? Well, because it's being utilized as resistance, and if price is placed above it, I anticipate it to be utilized as support. Meaning if price returned to it, I would anticipate it being utilized as support. You see I've annotated this bearish order block now. Notice it was utilized as resistance. Price then retraces into it. This is a potential entry opportunity because I anticipate it to now be utilized as support. I've now annotated these bearish order blocks that have been utilized as resistance on price multiple times. Once price is placed above them, must be utilized as support. And so I'd anticipate this array now to act as a discount array. And if returned to, that would be a potential entry point to go long. Again, I've annotated this imbalance here. Notice it's been utilized as resistance on price, important price range. If we displace above it, it should be utilized as support. That's a potential entry opportunity. You saw me annotate this small imbalance here on the right side of the curve. Price then displaces above the imbalance. If price returned to it, like it is now, that will be a potential entry opportunity to go long. And we can see it was utilized as support. I've also annotated this bearish order block here and this imbalance here. And so what I'm showcasing to you here is when we have a market maker model present and we're now trading the right side of the curve, all we need to do is find arrays that formed on the left side of the curve, extend them to the right. Once price is placed above them, that is a potential entry opportunity. What I'm not saying here is to enter the trades. What I'm saying is it's a potential entry opportunity. Why should you not enter the trades? Well, because you also need to have a valid invalidation level and a valid target, which is what we're going to discuss in the next lectures. But these arrays that form on the left side of the curve, once it's placed above on the right side of the curve, must be utilized as support, meaning by definition, that's where our entry opportunity is going to form, because that's where the accumulation phases form on the right side of the curve. We're now going to look at one final opportunity where I trade both sides of the curve. And what you're going to see me annotate are only arrays that form on the left side of the curve. So what we can see now is original consolidation, left side of the curve. I'm now anticipating a smart money reversal being in soon. And so we'll wait for CSD to occur. I've now gone down to a 15-second time frame. We now had a change in the state delivery. And so what you're now going to see me annotate is an imbalance that formed on the left side of the curve. And once price retraces into it, that's going to be my entry. So I've just entered short. Why? Well, because we've retraced into these consecutive imbalances here that formed on the left side of the curve within this market maker sell model. Entered short. Price now displaces lower. We've now taken out the original consolidation, so I can't refer to arrays that form on the left side of the curve. I now have to refer to arrays that form on the right side of the curve. Well, we can see we've got this imbalance here. Again, if your drawn liquidity was lower, this would be another entry opportunity. Price reaches the target. I'm now going to trade the right side of the curve. So this was the short on the left side of the curve. If you'll notice now, this market maker sell model, this was the left side of the curve. For this market maker buy model, this is the left side of the curve, meaning the right side of the curve for the sell model is the left side of the curve for the buy model. If you're confused, don't worry. Just think about what I said. We have a market maker sell model into a market maker buy model. Now we've got original consolidation, left side of the curve, smart reversal, right side of the curve. Notice this imbalance here that's been utilized as resistance multiple times. Price is going to now utilize that support. There's a reason why I didn't enter here. More on this when we discuss invalidation levels, but we anticipate it to be utilized as support. You're going to see me now enter the trades. Why? Well, because we've got this bearish order block here that formed on the left side of the curve. Once it's placed above on the right side of the curve, must be utilized as support. And so I utilize that as my entry points. What you'll see is the price is going to reject the low end of the order block. Perfect bullish institutional order flow. We've now got this bearish order block here, or these consecutive bearish order blocks. Once it's placed above on the right side of the curve, must be utilized as support. And we can now see prices utilizing them as supports. Again, another entry opportunity, assuming you have a valid invalidation level. Price is now retraced back into the bullish mitigation block. Another entry opportunity here. Price is now taken out the original consolidation. We've displaced above these bearish order blocks here that formed on the left side of the curve. Must be utilized as support. Price retraces into it, utilize that support, and then expands higher. Because I haven't got anything to refer to now, we're above the original consolidation. I have to now refer to the right side of the curve. And so I've annotated this large imbalance here, which now must be utilized as support. Again, if your drawn liquidity was higher, this is a potential entry point. And then finally, exit the position at the drawn liquidity. And so what I'm showcasing to you here is all I'm doing is identifying arrays that form on the left side of the curve that I anticipate to be utilized as support or resistance on price. I extend them to the right. And then once price is placed above them, that becomes my point of interest for an entry point. It does not mean I enter the trades. Why? Because I also need to have a small enough stop loss to enter the trades. More on this when we discuss invalidation levels. But once we have an array that we anticipate being utilized as support or resistance, that is an entry point or potential entry points, and that's what we're going to utilize to enter our trades within the context of a market maker model. So that brings us to the end of today's lecture on entries. Remember, we utilize the left side of the curve to measure order flow on the right side of the curve, and I've showcased to you exactly how to do this. You find the array, you extend to the right, and once it's spaced above, that becomes your point of interest for an entry. In the next lectures, we're going to discuss invalidation levels and targets, which is going to filter out a lot of the entries because not every entry is an opportunity for you to buy or sell. You also need to have a small enough stop loss with a large enough target. I hope you found some value from this lecture, and with that, I'll see you in the next video. Be safe.